Hi, I'm Michael Mruger, and this is Rob Mangold. We're from MoneySmartBoard.com. Rob runs the 401k division of our company. Today we're going to be talking about employee 401k loans, which are kind of a commonplace in retirement plans. Employees often want to take 401k loans to finance houses, trips, whatnot. So Rob's going to walk us through the ins and the outs of these types of loans and whether it's a good idea to take them or not. So Rob, I'll kind of start off with the first question, which is, what are 401k loans like in general? Like, how do they work? So people have a general idea.
Yep. So essentially 401k loans just give you the option to essentially be the bank for yourself. So essentially you have a retirement savings account, you have your balance up there, and you can essentially access that balance. It gives you access to retirement savings, which you usually wouldn't have. Borrow from yourself, and you essentially start paying yourself back money. Payments get set up in payroll, deductions in your paycheck, and that essentially goes back to pay back the loan within yourself. So again, it just gives you some option to some sort of cash flow to essentially borrow from yourself and pay yourself back, which you might not have other options available to you.
How much can you borrow,
Yep.
when it's a 401k loan?
Yep. So there's maximum. So the max you can have out during a 12-month period is $50,000. And then it's usually 50% of your vested balance. So if I have $10,000 that's in the 401k plan, $10,000 that's vested, I borrow $5,000 up to that amount, and then I set myself up to pay myself back that amount.
Now, how much do the payments, like if I decide to borrow $5,000 from myself, like how much are the payments for me to do that?
So payments do vary. Typically there's a loan calculator or something like that available on the platform that you have, so you can know what's going to be coming out of your paycheck to pay yourself back, and it all depends on how long you take the loan for. So essentially you can do it typically from 1 year to 5 years, up to 5 years. Sometimes you can stretch that out depending on what the loan's for and what type of plan you have or the specifics of the plan, but that's typically, it does vary. So
do I get charged interest for the loan, or how does that work?
there is interest, but it's essentially, since you're borrowing from yourself, you're paying yourself back. So you don't technically get charged it because you're paying yourself back that interest instead of paying it to a bank or some other kind of loan option to you. So there is interest available. It's set differently based on the plan. But there is interest, but you pay yourself back the interest. So when you're looking at kind of fees and whatnot, it's not necessarily a fee because you're paying that back to your own account. You're in retirement savings.
Now, if I all of a sudden come into some money and I want to pay back my loan early, can I do that?
Yep, most plans do allow you to pay it back early. Check whatever it is, payroll deductions, just higher amounts. So there are options that you can pay yourself back early typically in plans.
And there's usually no penalty for doing that?
No penalty.
Okay. No. Well, like when employees come for like loans from these type of plans, like what do you normally see them using? What's the main reasons why people take loans from the plans?
Yep, so when you're looking at it, again, it just gives you some access to cash that you don't have to qualify for another loan from a bank, or you just need that access to the cash, whether it's paying off credit card debt that you have, that you're paying a bank or a credit card company 20% interest every single year, or whatever it is. So it gives you access that you now start paying yourself back the money. And again, if you don't have access to another sort of lending source, then it just gives you some access to cash to borrow from yourself.
So what are some situations that you would recommend saying, hey, it probably makes sense to take a 401k loan in this place, in this position?
Yep, the most common I see usually is if there is a big credit card bill. Again, credit card companies charge arm and a leg once you reach certain amounts, and you just continue to roll that over. So if I owe $10,000 to a credit card company and I'm just making minimum payments and I'm getting crushed on interest and I'm paying to a credit card company every single month and not seeing that balance go down, that's typically where it usually helps out the most, because again, just having less debt outside that you're paying a credit card company interest is just less expenses to you. And again, sometimes there's just cash that's not available anywhere else. You need it. There's no other distribution options available to you within the 401k plan. So again, it just gives you that access to cash so you don't have to qualify for anything, because it's your borrowing from yourself.
Okay. Now, do these loans, if I took a loan, does it show up on my credit report, or is it invisible, or how does that work?
Since you're borrowing from yourself, it doesn't show up on a credit card report or anything like that. You're borrowing it from yourself. If you default on the loan for whatever reason, you're not making payments, you leave a company or whatever it is, then it does technically default. But again, it doesn't show up on your credit score since you essentially are borrowing it from yourself. But it is treated as taxable income. So essentially, if you default on a loan, I had $2,000 left, I either left the company or I'm just not making payments on it anymore for whatever reason, and that loan does default, that $2,000 that I owed on the loan gets added to my taxable income for that year. If I'm under 59.5, taxes and penalties will apply. But again, it doesn't show up on your credit card report. It's just kind of treated as a distribution from a retirement plan.
That's I guess now that you touch on that, that's an important piece, like that whole loan default thing. So if I have 10,000 left on a loan and I leave my company, like, and there's still that loan outstanding, normally I would just roll my balance over to my next employer, but with that loan sitting there, how is that? So if I've got, let's example, $50,000 in my 401k plan, and I've got this $10,000 outstanding loan. I go to a new employer, want to roll over my balance.
Yep.
What happens, like in that situation, like where that amount's still due?
Yep. So essentially, if it's not paid back, it defaults. So when does it default? The earliest of either two options. So again, there's a balance left, you don't pay it back. If you leave and you take a distribution, that loan's going to default. So you can't use other retirement money or anything like that to pay off that loan before you roll it over. That loan will default if you take that distribution, and again, treat it as a taxable income to you in that year that you take it out, or the quarter after the quarter end after the quarter you leave. So if I left today, and today's in August, 9/30 is the end of this quarter, and then 12/31 would be the time that it actually defaulted. So whether you take a distribution or that kind of time period whenever you leave, that's when the loan technically will default.
Okay. When do I get tax? So if I default on a $10,000 loan, is the tax due immediately? Do I get a tax form? Like, how does that work?
So you have till tax filing plus extension to pay the taxes. So essentially that form, or it does get defaulted, you'll get what's called a 1099-R. It says, yep, you took essentially a distribution from your 401k plan because you didn't pay back your loan, and then you essentially pay yourself, or you pay the government when you go and file your taxes.
Okay, and I think you said it's ordinary income tax and then a 10% penalty if under 50 and a half. So that could be huge if I'm like higher income earner, like plus the 10, it could be like 40, maybe even 50% of my balance.
Absolutely.
Yep. Wow.
So it's essentially just more income getting added to the top tax bracket that you're paying taxes on, because it's just above and beyond whatever you earn that year.
Gotcha. Even though loans give you some access for money in the plans, like as a financial planner, like what are the downsides to taking 401k loans?
So there's downsides. The biggest, again, I mean, you're planning on saving for retirement. You need a certain balance to be able to retire and to be able to last you throughout retirement. So the more you have in there, just the better shape you'll be in when you get to that position. You take out $5,000 from the plan. That $5,000 is no longer in the market. It's no longer compounding interest for you and earning. So there's times, and you can look at kind of schedules and stuff like that, that if I borrow X amount of dollars, how might this impact me over the long run? So from that side, definitely you're just pulling money away from retirement that should have been earmarked for retirement to pay for other stuff that's going on. But again, there's definitely times that the loans do make sense. So again, it just gives you that access to it, that if you really, really do need it, that you're taking it out. But again, from a saving standpoint, retirement standpoint, it could hurt you over the long run. You might be working another year or 2 years because you're now borrowed from yourself instead of letting that money sit and just keep earning.
All right, good stuff. Hey, this is really helpful.
Yep, absolutely.
Thank you everyone for tuning in. If you like this video, make sure you hit the subscribe button below so we can bring you more 401k tips. Thank you.